Hey everyone, welcome back to Corporate Decoder. Today, NXG Cushing Midstream Energy Fund NXG announced significant changes following their annual meeting, and it signals a potential shift for the company. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big story here revolves around a change in control that triggered a new advisory agreement, and we need to see if this is a positive step or just a reshuffling of deck chairs. NXG Cushing Midstream Energy Fund, Scroll, so the NXG Cushing Midstream Energy Fund, ticker SRV, recently held its annual shareholder meeting. This is where shareholders vote on important things like the board of trustees and major agreements. This year's meeting, which happened back on the 18th of June and was adjourned until the 10th of July, brought about a couple of key developments. First off, the shareholders elected two Class I trustees, Mr. Brian R. Bruce and Mr. John H. Albin. They will serve until the fund's 2029 annual meeting. This means the leadership in terms of board oversight remains stable with these individuals. More significantly, the shareholders also gave the green light to a new investment advisory agreement with Cushing Asset Management LP, which is the advisor to the fund. Now, you might think an advisory agreement is just standard business, but the details here are what really matter. The trigger for this new agreement was a major change happening behind the scenes. On the 10th of July, NXG Cushing LLC, which is a company owned by some senior employees of the advisor, bought a stake in the advisor from Jerry V. Swank, the founder. This acquisition made NXG Cushing LLC own a controlling 62% stake in the advisor. This is a pretty big deal because it means a change of control at the advisory firm itself. When this change of control happened, it legally counted as an assignment of the old investment advisory agreement. Think of it like a contract that automatically ends when the main party handling it changes significantly. Because of this, the old agreement was terminated and a fresh one was needed. So, right after this transaction closed, the fund and the advisor signed the new agreement. Now, here is where we need to dig in. What is actually different, or importantly, what is the same? The filing explicitly states there are no material differences between the new and old advisory agreements. This is a crucial point. The services provided remain exactly the same. The advisor will continue to manage the fund's investments, handle buying and selling securities, provide research, manage records, monitor the portfolio, and even vote on proxies for the fund's holdings. Essentially, the day-to-day operations and investment strategy of the fund are not changing because of this agreement. The core functions remain identical, subject to the oversight of the fund's board. This is repeated for emphasis. The services are identical. This suggests the motivation behind the change was not to alter the operational aspect of the fund's management, and it gets better, or perhaps more to the point, the same. The advisory fee rate is also staying the same. This is incredibly important for investors. The fee is set at 1.25% of the fund's average weekly managed assets. This fee structure is what you typically see, but the consistency here means investors aren't facing an immediate increase in their costs due to this ownership change. Investors who liked the fee structure before should be comfortable with it now. Now, a quick note on how they calculate managed assets. It is basically the fund's total assets minus expenses, but importantly, it excludes liabilities or obligations related to investment leverage. This means if the fund borrows money to invest, that borrowed amount doesn't get factored into the base for calculating the advisory fee. This prevents the fee from inflating just because the fund is using leverage, and there is still that voluntary fee waiver in place. The advisor is waiving 0.25% of the management fee up until the 1st of February 2027. This effectively brings the management fee down to 1% for that period. This waiver was in place before and is continuing under the new agreement, which is a positive for shareholders, as it reduces their current expenses. The new agreement itself has an initial term of 1 year. After that, it can continue year to year if it is approved annually by the board and by a majority of the independent trustees, not affiliated with the advisor. This annual review process gives shareholders and independent directors a chance to re-evaluate the arrangement each year. Termination provisions are pretty standard. Either the fund or the advisor can end the agreement with 60 days notice, and the advisor can also decide to terminate it with that same notice period. The agreement also automatically terminates if it is assigned, as defined by the Investment Company Act of 1940, which is a key piece of legislation for these types of funds. Scroll item 9.01 FOIN. The filing also includes a section for exhibits. Scroll 10.1 FOI. The most significant exhibit here is 10.1, which is the investment advisory agreement between the fund and Cushing Asset Management. LP scroll 104 FOI, and exhibit 104 is the cover page interactive data file. which is standard for these filings. Scrolby, Fungen, Blake, Nelson, Twin finally. The report is signed off by Blake Nelson, the Chief Financial Officer, on the 10th of July 2026. This date is important as it aligns with the closing of the transaction and the new agreement. So, what is the story here? The core of this filing isn't about new strategies or financial results, but rather a change in ownership of the fund's investment advisor. The key takeaway is that despite this significant change in ownership, the actual operational and financial terms for the fund and its shareholders appear to remain unchanged. The services provided by the advisor, the fee structure and the fee waiver are all staying the same. This suggests that the ownership change was perhaps more of a succession plan for the founder, rather than a strategic shift aimed at altering the fund's performance or its cost structure. For investors in the NXG Cushing Midstream Energy Fund, this filing brings certainty by confirming that their investment advisory relationship and the associated costs will continue on the established terms. The risk I am watching is whether this stable period can translate into improved performance. While the cost is stable, the fund's effectiveness in generating returns will be the ultimate test. What I am actually looking for is how this new ownership structure impacts the advisor's long-term strategy and their commitment to maximizing shareholder value in the fund. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into company filings.